On Wednesday, Federal Reserve officials announced they are reducing interest rates by half a percentage point, marking a significant cut and the first of its kind in over 4 years.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
The Fed stated it's no longer as focused on slowing the economy to control inflation, as inflation has been steadily decreasing for several months now.
Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal.
Interest rate reductions are positive news for the overall economic sentiment for two key reasons. First, people generally dislike high interest rates since they make borrowing for major purchases like homes and cars more expensive, feeling like an added financial burden. Second, lower interest rates can help strengthen the economy over time. Reduced rates could boost demand, which might become stronger than before, stabilizing the labor market without a sharp slowdown. This is obviously good news for workers seeking wage increases and those directly impacted by the economy daily. The Fed faces two significant risks as it decides how quickly and by how much to lower interest rates moving forward. The first risk is that rapid rate cuts could cause the economy to accelerate too quickly, leading to persistent inflation that remains stuck at its current level. On the flip side, if the Fed keeps interest rates elevated for too long, the labor market might weaken significantly. Some economists are concerned about this, as recent months have shown rising unemployment and slower job growth. The worry is that if the Fed is too slow to ease these high rates, the economy might not just gradually slow, but could experience a sharper downturn. This half-point rate cut signals the Fed is somewhat concerned about the job market. Typically, the Fed adjusts rates by quarter-point increments, so a half-point cut is a more aggressive move, signaling they're trying to ease off the economic brakes a bit faster to prevent further slowdowns in employment and economic activity. Lowering interest rates generally helps accelerate the economy, which can be favorable for the party currently in the White House. While the Federal Reserve is an independent body and does not base its decisions on politics, its actions can certainly have political implications. Cutting rates right before an election brings the Fed into the political spotlight, a position they likely prefer to avoid.